Welcome to our deep dive into intelligent investing. We've got some really thought-provoking excerpts from Benjamin Graham's classic, The Intelligent Investor, and some insightful commentary from Jason Zweig. Let's see what we can unearth.
You know, Graham's work, it really highlights how easily we get fooled by market narratives, even seasoned investors, right? They can think they're investing when they're actually speculating.
Yeah.
It's a really subtle distinction sometimes.
He uses that memorable example. You know, the one of the investor selling stock they don't even own, just betting it will go down.
Right.
That's a great illustration.
Absolutely. It shows how emotional it can be, almost like gambling. And what's interesting is, Wall Street often blurs those lines. They package these risky bets as, sophisticated strategies, something to watch out for, especially for newer investors.
So how can we, as individual investors, avoid falling into that trap? What should we focus on to stay grounded?
Well, Graham offers a framework. It all comes down to intrinsic value. He argues that instead of, trying to predict those market movements, we should understand the true worth of a business.
Right.
And that's where his idea of margin of safety comes in.
Okay, let's talk about that. Margin of safety sounds like a built-in cushion, but how does it work in practice?
Imagine you find a dollar bill on the sidewalk, but you only pay 50 cents for it.
I like it already.
That's the essence of it. Buying assets for way less than their true value, it minimizes risk, gives you that buffer against potential losses.
He uses the example of the Washington Post company back in '73. What was that all about?
Oh, yeah. So the Washington Post stock was trading for $80 million. But get this, its assets could have been sold for $400 million.
Wow.
Talk about a bargain.
That's incredible.
It shows that true value, it can be hidden, especially when the market is kind of pessimistic.
Okay, so these opportunities, they still exist today.
Absolutely. A contemporary example, take a company like, let's say, I can't offer specific investment advice, but this is how deep analysis can find companies trading at a discount. You got to do your research.
Got it. So instead of chasing the latest trends, we should be looking for those hidden gems, the ones the market might be overlooking.
Exactly. And that leads us to another important point. The allure of growth stocks and market fads. Graham warns us about those speculative bubbles, where prices are driven by hype more than actual value.
He uses those classic examples, right? Texas Instruments, Cisco Systems, huge rises, then dramatic crashes. Are we still seeing those patterns today?
Oh, absolutely. Think about the dot-com bubble, the housing bubble. Even recently, in certain tech sectors, growth alone doesn't guarantee a good investment. It's about the price you're paying for that potential. Does it match the company's fundamentals?
Right. So how do we avoid getting caught up in those fads? Especially with all the information overload these days. It's overwhelming.
Well, Graham suggests a few things. One is dollar cost averaging. Another is investing in index funds.
Okay, those are familiar terms, but can you break down how those are helpful?
Sure. So dollar cost averaging is, consistently investing the same amount every month, for example, into a broad market index fund, no matter what the market's doing.
Okay.
So during downturns, you're buying more shares at lower prices. Upswings, you get fewer shares at higher prices. It all balances out.
So it's like averaging out your purchase price over time.
Yeah, exactly. And it helps you not to react emotionally.
Right. Removes that temptation to make rash decisions.
Precisely. It's all about discipline and patience. Focus on the long term.
That makes sense. Now, Graham doesn't just advocate for passive investing, does he? Doesn't he also talk about analyzing individual companies?
Oh, yeah, he absolutely does. He believed in understanding the financials before you invest, looking at things like earnings, debt, asset values. He even dives into specific ratios, like the debt-to-equity ratio.
He uses Micron technology as an example, right? With those recurring, non-recurring charges.
Yeah, Micron's a good illustration of how companies can sometimes manipulate things, or present info that hides the real issues. He wants investors to be savvy, to look beyond the headlines and see what the numbers are really saying.
So even with all the data we have now, we can't just blindly trust companies.
Exactly. You have to be able to analyze the financial statements, understand what they mean.
Okay, so we've covered intrinsic value, margin of safety, the whole growth stock thing, and analyzing financials. Anything else we should keep in mind as intelligent investors?
Yes, actually. Graham was big on understanding management and being an active shareholder. He thought evaluating the people running a company was just as important as the numbers.
He brings up the Enron scandal, right? Where all those conflicts of interest were ignored.
Precisely. He encourages us, as investors, to really scrutinize what management is doing. Read those proxy statements, the ones we often skip over, hold them accountable for their decisions.
Don't be passive, be active.
Right. Exactly. He believed informed shareholders play a crucial role, making sure companies are run ethically and in everyone's best interests.
This is great stuff.
Mm-hmm.
But it makes me wonder, how do we know if we're actually capable of applying all this?
Yeah.
Especially if we're not financial experts.
That's a great question. And you know what? Graham addresses that directly. He talks about the defensive investor and the enterprising investor, recognizing that not everyone has the same time or inclination or even expertise to analyze every company.
Okay, so let's get into these different investor profiles. Who is this defensive investor?
So the defensive investor, according to Graham, prioritizes safety and simplicity. They're not out to, beat the market, more like aiming for consistent returns without too much effort.
So it's more about building that solid portfolio.
Yeah.
And not constantly fiddling with it.
Exactly. Graham actually suggests roughly 50% bonds and 50% stocks.
Okay.
For bonds, he really likes the ones with guaranteed returns, like U.S. Treasury bonds, backed by the government. He saw them as a cornerstone for capital preservation.
Makes sense. What about the stocks? What kind of companies does he recommend?
He leans towards large, well-established companies, ones with a history of paying dividends and a track record of, surviving those market downturns, those blue-chip companies, household names.
Okay, so slow and steady wins the race. Focus on those quality companies for the long haul.
Exactly. And if you don't want to pick individual stocks, he also suggests mutual funds or ETFs, the ones that track the broad market.
Right.
That gives you instant diversification and professional management, which fits with the whole defensive investor thing.
And this is where that dollar cost averaging comes in handy, right? Consistently putting money into that diversified mix, no matter what the market's doing.
Oh, absolutely. It takes the guesswork out of timing the market, which Graham said was a fool's errand. You're basically taking advantage of those dips and smoothing out your purchase price over time.
Got it. So that's a defensive investor. What about the enterprising investor? What makes them different?
Well, the enterprising investor is willing to put in the time, do the research on individual companies, and potentially outperform the market. They're okay with a little more risk, and they're more active in managing their portfolio.
So Graham's acknowledging that there are different paths to success. It depends on your temperament, right, and your goals, and how much time you have.
Absolutely. He outlines a bunch of strategies for the enterprising investor. One is the classic buy low, sell high. But he does say that takes, a deep understanding of market cycles and being able to act decisively, often against what everyone else is doing.
Which reminds me of his analogy of Mr. Market. What was that all about?
Oh, right. Graham personified the market as this, fickle character, Mr. Market, always offering to buy or sell your stocks at prices that are all over the place, driven by fear or excitement, not logic.
So the idea is, don't let his mood swings influence you. Use them to your advantage.
Exactly. Recognize that the market doesn't always reflect the true worth. And those discrepancies, those are the opportunities.
Got it. Another strategy he talks about is investing in those carefully selected growth stocks, even if they're not a bargain right now.
Right. You're betting on the future potential, even if the current numbers don't look amazing.
But how do you evaluate a growth stock? Where do you even start?
He's very clear that it's tough. Identifying true growth stocks, he says, don't just chase trends or buy stocks with high price to earnings ratios without really getting the business. You have to understand that long-term potential.
So separate the real growth from the hype, which can be tough.
Absolutely. He's also cautious about, those market fads and bubbles. Even the best companies can have setbacks. And those high valuations can disappear quickly.
Right. If they don't meet expectations, it's about staying grounded in those fundamentals.
Exactly. Don't let the market cloud your judgment. Now, Graham also talks about bargain issues, or net nets.
Okay. What are those?
These are companies selling for less than their net working capital. You're basically buying their assets at a discount.
Like that dollar bill for 50 cents again. But there's got to be a catch, right?
Of course. Usually a reason those prices are so low could be temporary problems, or the industry's not doing well, maybe even bad management.
So the enterprising investor really has to do their homework, figure out if it's a true bargain.
Yeah, exactly. Separate the bargains from the traps. You need a good eye for it, and dig deep into those financials. Another thing he mentions is special situations.
What are those?
Think of things like mergers, acquisitions, spin-offs, things that can create, discrepancies in the valuation or unlock some hidden value.
Sounds a little complicated.
Yeah, it's more specialized, not for the casual investor, but potentially lucrative if you have the expertise. and
Yep.
the risk tolerance.
So whether it's buy low, sell high, or growth stocks, or bargain hunting, or these special situations, the enterprising investor is definitely more hands-on.
Yeah, much more analytical. But no matter which path you choose, Graham stresses the importance of discipline and patience, thinking long-term. He's always saying, don't try to time the market. Don't chase those trends. Don't expect to get rich quick.
It's more about like becoming a part owner of the business and participating in its growth.
Exactly. It's about developing that sound philosophy,
Yeah.
sticking to your principles, and not letting the market's ups and downs, control you.
Now, Graham's book is full of wisdom, but the investing world has changed a lot since he wrote it.
Oh, for sure. The market's different. Technology has disrupted everything. New types of assets have popped up. But you know what? Graham's core principles, they still apply.
So we might need to adapt the specifics, but the overall philosophy is still solid.
Exactly. For example, Graham talks about bonds mostly as individual bonds. But today, you have bond mutual funds and ETFs, much easier to diversify.
And even though analyzing those financial statements is still crucial, now we have all these online tools and data.
Right. Another big change is technology in general. Graham never imagined the internet or online trading. Makes investing much more accessible.
But that comes with its own set of challenges.
Right.
Too much information, easy to make impulsive trades.
Absolutely. Graham's emphasis on discipline and the long term is even more important now.
So how do we apply his wisdom to today's market?
Well, that's the big question. We can't cover everything, but I think there's some key takeaways that can help.
Okay, let's hear them. What are those essential lessons, the ones every intelligent investor should remember?
First, know the difference between investing and speculating. Are you focused on value or just betting on trends?
Got it. What else?
Embrace that margin of safety. Are you buying below the true worth?
Makes sense. Number 3.
Be careful with those growth stocks and market fads. Don't get seduced by promises. Look at those fundamentals.
Okay, number 4.
Consider dollar cost averaging and index funds. Simple and disciplined.
Right? What else?
Learn to analyze those financial statements. Understand the numbers. Be an active shareholder. Engage with the companies you own.
Anything else?
And finally, remember, this is a long game. Patience, discipline, focus on value. That's how you grow wealth.
So even though the tools might change, the philosophy is still the same.
Exactly. The Intelligent Investor is more than a book. It's a whole philosophy, and it can help anyone, no matter what their background is.
That's a great way to put it. It really captures what Graham was trying to say. So as we head into the last part of our deep dive, let's talk about the psychology of it all. Because even with the best strategies, our emotions can really mess things up. So we've covered a lot of the analytical stuff, understanding value, assessing risk. But Graham also talks about those psychological traps, the ones we all fall into, even when we know better.
Yeah, our emotions can really get in the way.
What are some of the big ones to watch out for?
Well, I think one of the toughest is how we react to market swings. When prices go up, we get all excited. When they drop, we panic.
Right.
And we end up making decisions we regret later.
He has that famous quote, something like, "The investor's chief problem is likely to be himself."
Yeah.
It's like we sabotage ourselves, so how do we stop doing that?
Well, Graham's point is that market fluctuations, they're normal. They're part of the game.
Okay.
Instead of seeing them as threats, we should see them as opportunities. Volatility, it's just the price you pay to be in the market.
So change your perspective. Don't be afraid of it. But how do you actually do that without getting emotional?
He has a few tips. One is to create what he calls an investment owner's contract.
Okay. What's that?
Basically, it's like a written agreement with yourself.
Okay.
You outline your philosophy, your goals, and your commitment to sticking to the plan no matter what the market's doing.
So it's like a reminder
Yeah,
when things get crazy.
exactly. Another thing he suggests is limiting exposure to financial news.
Seriously.
Yeah, I know it sounds counterintuitive,
It does.
but all that information, especially the way it's presented, it just fuels our emotions
yeah.
and leads to bad decisions.
He wrote this way before 247 news channels.
Huh.
And social media. It's constant now.
I know. So much noise. It's more important than ever to be mindful.
Right.
Focus on what you can control.
Your own strategy, your risk tolerance, your long-term goals.
Exactly. Graham also talks about comparing ourselves to others, like keeping up with the Joneses.
Oh, yeah.
Yeah.
It's so easy to fall into that trap.
He warns against it. He says there's no reason to think the average investor can consistently beat the market.
Right.
And trying to do that just leads to taking too much risk. and ultimately being disappointed.
So define success on your own terms. Don't compare yourself to everyone else.
Exactly. The intelligent investor focuses on what they can control. Their own research, their own analysis, their own discipline. They don't follow the crowd. They trust their own judgment.
That's a great point. It's about taking ownership of your own financial journey, not letting outside factors control you.
Right. And it all comes back to being an intelligent investor. It's not just about the numbers. It's about having the right mindset, being resilient, and always learning.
Because the market's always changing, right? New challenges, new opportunities.
Yep. We have to be able to adapt, stay open to new ideas, but always keep those core principles in mind, the ones Graham laid out.
So as we wrap up this deep dive into the intelligent investor, I feel like we've just scratched the surface.
Yeah, there's so much in there. It's a book you can keep coming back to.
Graham said, the intelligent investor is a realist who sells to optimists and buys from pessimists.
That's a good one.
It's about staying level-headed. Don't get caught up in the hype or the fear.
Right.
Make decisions based on sound analysis and the long term.
Zweig also has a great line in his commentary. He says, by the time everyone decides an industry is obviously the best one to invest in, it's almost always the worst.
Oh, yeah. That's a good reminder.
Don't follow the crowd. Think for yourself. Trust your gut.
Well said. So that's it for our deep dive into the intelligent investor. Hope you found it helpful and maybe even a little inspiring. Now go out there and invest intelligently.